Welcome to the virtual gold conference, ladies and gentlemen, and our opening keynote speaker, Mr. Grant Williams. Now, for those of you that don't know Grant Williams, you should go to grant-williams.com. Grant has been in the finance markets for, goodness me, probably the last 35 years, even though he doesn't look nearly like he's had that much time in the markets, but he has lived and breathed finance. And the reason that I was really excited to have Grant open our virtual gold conference today is because not only does he understand gold and precious metals and wealth and what takes it, but he also looks at the bigger picture. So, Grant, first of all, thank you so much for joining us today, coming to us from the United Kingdom.
Kerry, it's a great pleasure. Thanks for having me. Good to see you again.
Yeah, great to see you. And the last time I saw you was in Vancouver, and a great presentation called Cry Wolf. And if people want to have a look at that, I think they can see that online. But we'll talk about that a bit later.
It's on my website. It's on my website. You can see it there. Yes, absolutely.
Okay, so ladies and gentlemen, do yourselves a favor. Go check out grant-williams.com. Go and check out his presentation called Cry Wolf. It is fabulous. You've also got some podcasts. I think 4 different podcasts. There's my favorite one, the Super Terrific Happy Hour, the End Game, the Narrative Game, and then, of course, the Grant Williams podcast. So without further ado, you've been in finance for a long time. You have been all over the world, from Singapore. You've actually spent time in Sydney, Australia. So we are going to talk about the Australian markets and your views on that. We're going to talk about gold. You actually started a newsletter, Things That Make You Go,
I did.
Which I love as well. And that was started in 2009, and it's very much a financial publication. Grant, Where are we right now in this crazy, as you often say, volatile markets?
Oh, well, that's a big question. Yeah, look, it's I guess the simplest way to put it is just the madness keeps getting madder, right? I mean, there are certain problems that the world faces, and the solution to them is unfortunately going to be a particularly painful one. But for the time being, everything is being done to avoid the solution, frankly, to keep the kind of the problems that we've been building up over the last 40, 50 years from reaching their inevitable conclusion. So you have markets that are going up and seeming to only go up, which has obviously done what one would expect, which has instilled a lot of investors with this kind of feeling of bulletproof, and this buy the dip mentality has just become more and more ingrained in people over the last sort of 10 to 15 years, ever since the financial crisis, when the Fed and the other central banks stepped in to kind of rescue everybody. And this idea that the Fed, the central banks, have your back has gotten deeper and deeper into the psyche of investors. And so, while optically everything looks fine, and it's been absolutely fine to play the markets and just be long and enjoy the ride north, I think what I and a lot of other people have been talking about is just be aware of the kind of fragility of the market you're in. It's fine to be in, but as long as you understand that the market is going up despite the underlying economic conditions rather than because of, you stand a much better chance of recognizing the eventual unwind when it begins. And that's really the best that people can do right now, is understand what this is really all about, understand why the markets are going up, and have a plan for when they stop going up and start going down, which will happen, unfortunately. That's really all. People get called doomsayers for talking about this stuff, and nobody likes in buoyant markets. Nobody likes someone to come along and say, "Hey, that's fine, but did you know this?" And unfortunately, history is filled with people like that kind of warned about these things beforehand, were hated while they were being warned, while they were doing the warning, were despised when it happened. And that's the lot of the realist, unfortunately. But look, the market is going higher. But if you want to look at anything other than the price of these things, then there's a completely different story to be told underneath. And I think that's what I and plenty of other people have been trying to get people to pay attention to.
But you say that we've got to pay attention to the fact that markets might not go up forever. But right at the moment, we have interest rates pretty much zero. let's call it free money. We've got that wonderful printing machine that just doesn't seem to stop. We've got lots of infrastructure projects happening globally. I mean, look at what Joe Biden's doing in the US, the trillions of dollars worth of stimulus. So won't that just put a rocket fuel under markets to make them even stronger going forward? Are we looking at the roaring 20s if we look back at history?
Well, look, could that happen? Of course it could. Of course it could. But what you're starting to see now is the kind of stimulus that is very likely to create significantly higher inflation. QE has been to the order of multiple trillions of dollars around the world. It's gone into bond markets and it's floated asset prices higher. And I'm sure you being down in Australia, we'll talk about the Australian housing market at some point, but that's really just kind of best in breed, if you like. The same thing is happening all around the world. In fact, it's starting to pick up pace in the US. Here in the UK, I've been astonished by the housing market, the strength of the housing market. But if you look at that one way, it's a strong housing market. If you look at it another way, it's really strong inflation. And of course, the way that the stimulus has been applied until last year, when the pandemic kind of necessitated a different approach, that stimulus has gone into assets. And so while the stock market isn't thought of as going up because of inflation, that's really what's been happening as people have been, as the rich have gotten richer, thanks to low interest rates and being able to borrow all the money they want and lever things up. That money has gone into houses and it's gone into collectibles and it's gone into the stock market. And so those things have experienced tremendous inflation. But thanks to the pandemic, the stimulus that's kind of the baton's been passed from monetary to fiscal, and that money is starting to be targeted directly into the pockets of consumers with a very clear outcome. We want to have inflation run hotter than 2% for a period of time. We have no idea what that period of time is. We have no idea how much hotter than 2% they want it to run, but they want it to average 2% over time. We have no idea how long the time period is. So there's so much wiggle room here for central bankers to claim inflation is transitory and that it's not really reached the point where they feel it's reaching their targets yet. In fact, on the Endgame podcast recently, we spoke to a good old Aussie, Gerard Minack, about this exact thing.
Yeah.
Gerard pointed out the recent move by the RBA to essentially pin inflation to wage inflation, i.e. saying until we get 4% wage inflation, we are going to deem other inflation as transitory. Now, that is a real change in direction, one that I suspect will be aped by other central banks in the fullness of time. So we have an incredibly inflationary environment here. It's been reflected in asset prices, particularly housing. But if we do now get any kind of serious inflation, with the amount of debt in the world right now, it becomes a huge problem, particularly when central banks are desperate to keep rates low around the world, to keep not just the party going, but to keep the wheels on things right now. I think anyone that understands these things and has read a little history understands what happens when central banks lose the long end of the curve, which they would do very, very quickly, given the relative levels where everything is if inflation started to take hold. So the stimulus has worked thus far, but one could actually argue that the reason it has worked is that the ill effects haven't been felt so far, and we seem to be at the point where if UBI and MMT and all these kind of crazy theories about how there really is a free lunch and we can just print all the money we need and everything will be fine, if those things really get hold, and look, if you read the news and you pay attention to what's going on, that is where we're headed. We could see very, very quickly the kind of dark side of what's happened over the last 10 years. But for the most part, for the meantime, all that really matters to people is the stock market going up every day. I think Bitcoin is a representation of this. It's a representation of people looking to get out of fiat dollars and into something which they believe not only will protect them, which is, I think, what a lot of the kind of people that really understand Bitcoin are doing. They're using it as a hedge to protect them against destruction of the dollar. But of course, it has this wonderful second order effect that the prices actually just keep going up. And so that's dragged in a lot of other people into this thing who just purely are seeing it as a speculative vehicle. But I think its roots are very much in protection against debasement. So that, that's a kind of a big picture look at it all. And we could dive into any bits that you want, but I think that's the reality behind not just the narrative, but the kind of general understanding of what's going on based on headline house prices going up, headline stock markets going up. Everything feels like a boom time, to your point, but the reality behind it is much more problematic, I think.
It's interesting because on the conference day, we have people, because I checked who had registered. We've got people from all over the world that have registered to come and have a listen. And it seems to me that you mentioned property. Is that the first? I mean, and the stock market's going up as well, but it seems like the attention is on property at the moment and the hysteria is on property. And you mentioned the Australian property market, UK, US. Is that going to save us, or is that going to put us into a deeper debt cycle, which ultimately will hurt a lot of people as they're heavily indebted if interest rates begin to rise, which I think inevitably they will? Or do you think that we're going to have continued suppression of interest rates because the governments can't afford to let them rise?
Yeah, look, rates can't be allowed to go up. We've seen all sorts of talk about potential yield curve control. I mean, the Bank of Japan are already doing it, and I suspect that is a very real situation we'll have to face in perhaps the not too distant future. But when you look at housing markets going up and ask, can that save us? It's a problem because obviously a significant part of the housing market is debt funded. I mean, people take out a mortgage, and there aren't many people that buy houses for cash, and the ones that do are generally at the top end where it doesn't make any difference to the broader economy. So as the prices go up and wages do lag behind, as they clearly have right across the world, then obviously people are, by definition, having to take out more leverage to buy the home. And so, I'm here in the UK, and my daughter and her partner are buying their first home, and I've been astonished to see the prices of homes in the UK. I've also been astonished to see the kind of leverage that is being offered to first-time buyers, given it wasn't that long ago that we had a significant housing bust, not just in the US, but right around the world. And you can see that the strong house prices are really a function of that leverage. If that leverage wasn't there, the price will be wholly different. In the UK, there's been a stamp duty holiday since the early days of the pandemic. They've extended it a couple of times. It supposedly runs out in June here. Already, obviously, people are talking about them having to extend it. Prices are reflecting that. People trying to buy houses now are trying to do them quickly before the stamp duty holiday ends, because it's a meaningful saving. It's a material saving for people doing that. Can they afford to end the stamp duty holiday? What would happen? Prices of UK houses, one would imagine, would fall 10% or so based on the stamp duty being reimposed, and that makes for a terrible headline, and it does no good for confidence. So can they afford to let that stamp duty holiday lapse now they put it in place? Well, emotionally, they probably can't. If you do let that lapse, prices will adjust accordingly, and the psychological effect that has on all the people who've just paid up for their house and see it notionally fall by 10% in overnight almost is too big a problem. But can the UK government afford to not take in the amount of stamp duty that they would be?
It's a rock and a hard place.
Of course. But there's obviously there's a solution to this. Well, we can afford to extend it and give up that stamp duty income because we can just print the money to replace it, and it'll be fine. Now, look, I think anybody with either a remote knowledge of history or, frankly, any common sense understands that you cannot just pull money out of thin air and it be okay forever. I mean, why the hell do any of us work? We might as well just all take money off the government, have a nice house, have a nice life, and it'd be fine. Of course it doesn't work. But it has worked seemingly for a decade now. And that's long enough for people to extrapolate forward and assume that, well, look, this does work. And if it does work, we can keep doing it. we had Rishi Sunak, the Chancellor here in the UK, talking already about having to somehow pay for this stuff. And, already it's clear that he understands that this is not a free lunch and there will have to be something on the other side of this. But he also saw the backlash that happened when he talked about this, I think too early, but look, he was being realistic. And that's a problem that every central bank governor in the world, every head of the treasury in the world is going to have to face that come to Jesus moment where the numbers don't work. But unless we continue to do what we've been doing, the wheels fall off this thing pretty quickly. And one of the first casualties of that is likely to be the stock markets, which around the world have reached valuation levels which in many cases make no sense whatsoever. And people can say, well, the markets can stay irrational longer than you can stay solvent. And that's completely true. And a lot of people are talking about the blow off to come, which is completely possible. But I guarantee you that in 1929, right before the stock market crash associated with the Great Depression, I guarantee you there were people saying, get ready for the blow off top, right? People are going to be talking about the potential blow off top to come right until the peak has been passed. The markets keep making record highs. They're kind of sucking fumes a little bit, and everyone's expecting this market to rocket higher. But what if it already has? We don't know that, and we'll never know that until, sadly, long after the event. But the thing that I warn against, and I think other people need to warn against, is just the danger of not paying attention, the danger of assuming that markets go up, and you will get an email from someone warning you that tomorrow's the top, so sell today. Those things don't happen. So you need to pay attention. You need to have a plan, and you need to be fully cognizant of the reality here, which is the fact that these are not strong economies. The stock markets are where they are purely because of low rates and essential limitless liquidity and nothing more. And if they have to re-rate to a more pragmatic valuation, it's a long way south of here. So just understand that. And it's not saying sell everything and get out of the market. It's saying understand that and know what to look for to have a sense that this is coming to an end.
Gran, you mentioned earlier that your daughter and her partner are buying a house. What advice did you give her? Did you say pay attention to the danger?
Well, look, it's slightly different. I think for anybody who's buying a home is different to buying a house. We all need somewhere to live. And so, my caution to her were really just about making sure that you don't stretch yourself with the payments you have to make. Because look, if you buy a home that you can comfortably afford to pay the mortgage, look, it doesn't matter if the price goes down. If the price goes down 10%, so what? You can make the payments, the valuation's gone down, but so likely will every other house around you. So you're not materially worse off. The problem comes with people who are buying, buy-to-let properties and rental properties and second and third houses. They feel that we can borrow a lot of money, gear up, and then the rental income from those will pay the pay the running costs, and we'll make a massive capital appreciation on the property. And of course, that's been a very, very lucrative business line for decades now. And so it's just accepted that if you once you're able to borrow money, you buy another property, you rent it out, the value of the house goes up, the rental payments pay the mortgage payments, and one day you sell it for a huge profit, or you take another mortgage out with the equity that the appreciation equity that you've got in that home, and you do it again, rinse and repeat. Particularly, nowhere's been better at this than Australia. Let's face it. And again, it's the same idea. Just because it has worked doesn't mean it always will. And the longer we get away from people who remember what it's like to sell a house at loss. My first house I bought, I lost money on it. And people are like, "How does that happen?" But
Really?
I bought it in the sort of the late 80s housing bubble, and when I sold it, I actually lost money on it. Now, the house I sold it to buy in the end, obviously, had come down in price as well. But mentally, you kind of the decisions you make when selling a house when it's underwater become very different to, shall I cash out of this investment property I've got? It's a very different mindset. So Getting back to my daughter, I just said, look, you need to make sure that don't borrow as much as they'll give you, borrow as much as you need to buy the house you want, right? And I was astonished at the amount of leverage that they were being offered. And I cautioned them very strongly against taking all of it out. And thankfully they've listened to me. But it's the height of enabling, frankly. I mean, the banks forget what happened 15 years ago. They were burned by that, but everything that they've seen in the interim suggests that if it happens again, they'll get bailed out again. And so, we're back to 80, 90% mortgages being commonplace. There's talk about 100% mortgages coming back again soon. We never learn the lessons of the past, and when the lessons of the past are not imposed because it's too frightening for the central banks to let those lessons be learned by a generation of investors and speculators, it's only natural that they'll do it again, and here we are.
Well, monetary policy is really interesting, as you were mentioning just then. There is a wealth gap, which I find astonishing at the moment, and this is getting global. I mean, there are people out there that are living paycheck to paycheck. Wages have not increased with the costs, and you mentioned inflation before. Do you see that we're going to have potentially some social unrest going forward, or do you think the party can just keep on going and the wealthy will get wealthier, housing prices will go up, and those that are doing well will be fine, and we're just going to ignore that annoying bit on the side, which is the homelessness and those people that are really struggling at the moment?
Well, sadly, throughout history, those things are always ignored until it's too late. The French ignored it until the revolution came around, and people were looking up at their bodies from baskets under the guillotine. So sadly, that's the way these things happen. The wealthy get wealthier, and they love getting wealthier. They don't seem to want to give any of that up, and it reaches a tipping point where the poor have relatively become so poor. And they see all this wealth around them, and they want to do something about it. And those things generally don't happen with a friendly conversation over a pint, So we're seeing the beginnings of that. There's no doubt about it. We've seen that in the last 12 months, I think, right around the world. We're seeing the kind of disenfranchised start to become resentful of the rich. We're starting to see the rich get so much richer in a short period of time. The pandemic arguably is the blue touch paper for this, because there hasn't been an event in my lifetime where the poor so quickly became dramatically poorer and the wealthy became so egregiously better off over that period of time. And why? Because the wealth have all their wealth is concentrated in assets, it's concentrated in homes, it's concentrated in Van Goghs, it's concentrated in equity, in shares in the companies they've owned and built. And of course, thanks to the policy, all those things skyrocketed higher, while people on the street were being given stimulus checks by the government for a few $100s to make ends meet. And I think that was one of the reasons behind all this crazy speculation that we saw in the markets and around the turn of the year in the GameStops of the world. And again, back to some of these crazy Dogecoin, all these weird cryptocurrencies that really have no merit whatsoever other than a speculative vehicle. So the point you make is absolutely right, but I don't think it's a problem that's coming. I think it's a problem that's very much here. We just aren't seeing the kind of the triggers yet. And what worries me is that inflation, which the Federal Reserve are not only committed on generating, but we've seen Fed governors recently come out and say that, inflation below 2% hurts families, which is just a farcical statement.
Awful.
But yeah, look, it's ridiculous. And the Federal Reserve, and I use them as a proxy for every central bank in the world, are absolutely the cause of this. Not only that, but the lengths you have to go to connect the dots between central bank policy and the growing wealth divide are, two maybe at most. And yet we have central bankers getting up, giving speeches and saying not only do they not really see any problem with wealth inequality, but they certainly don't think their policies have anything to do with it. I mean, it's mendacious. Wow. It really is. I mean, I've debated long and hard whether these people are clueless or they're just barefaced liars to the public. And I ultimately realized it doesn't matter. they're either liars or they're so stupid that they really don't see this. And I honestly don't know which is worse. But the reality is, as you point out, the wealth gap has become a problem. And if you add into the mix inflation, which these guys have said that we are committed to achieving, not only that, but we're going to let it run hot, then that's the only spark you need to set this thing off. And as inflation starts to show up in the prints, which we saw in the most recent numbers, yes, they're off particularly weak comps from last year. A lot of people are saying, well, this is just transitory because of the numbers last year were so low that, of course, we're going to get it, that it's all going to settle down again. You know, I have my doubts. If you look at input costs, look at some of the companies that are already talking about having to pass on surging commodity input costs to people.
Yeah,
this is happening. And there was a recent survey done, the numbers just published last week, and some 93% of people surveyed were worried about inflation in the coming year. Now, inflation is ultimately an expectations game. If inflation expectations get out of control, that's really all you need. If people fear inflation, then they take the kind of actions that lead to inflation. They spend their money faster. They're worried about having to wait for it. And that's, you know, the kind of self-perpetuating circle begins in earnest. And that's where we are. And so this whole idea that we can let inflation run hot for a little while and then tamp it back down to 2%, and we're doing you a favor by giving you 2% inflation, it makes you better off. The whole thing is ultimately going to be exposed as nonsensical. The only worry is, does it get exposed through realization on the part of people that the wool's been pulled over their eyes, or does it get exposed via some sort of violent insurrection? And you would have to say, looking at what's happened the last year, that we are far more likely on a course to the latter rather than the former, and that should be reason for people to be at least thoughtful about this, and if not, concerned about it.
When you speak about inflation, Grant, and as I said at the start, you've been in finance for 35 years. You've seen a lot over the years. When, because I speak to a lot of people, and some of them turn around to me and say, no, we won't see inflation. But I'm looking at commodity prices, copper prices, oil prices, prices of lumber. It feels to me like inflation's on the way. But when it hits, it can hit pretty quickly and pretty violently, can't it? And would you see that can very quickly turn us from where we're sitting at the moment, where people are comfortably thinking that everything's okay because the stock market's going up and my house is worth more? So they have a funny way of thinking they're more wealthy, but in fact, ultimately they're not.
Well, look, Bernanke and Bernanke and Yellen talked very famously about the wealth effect. That was the idea of this, was to make people feel wealthier, so they'd get out and they'd spend money in the economy, which is great, right? But in theory, if you feel wealthier because your house has gone up in value, the only way to really go out and spend that in the economy is to take out more leverage against it, take the equity out of your home, and spend that. If you feel like you're wealthier because your stock market portfolio is going up, well, guess what? Do you sell your stocks? Well, no, because the market's going up. What you do is you take out margin debt against them and spend that, because, hey, markets always go up. I'll borrow against my portfolio and it'll be fine. So the wealth effect is a very dangerous thing, because it'd be great if the Federal Reserve were talking about wealth, but they're not. They're talking about the effect of wealth and the effect of essentially paper wealth. It's not real wealth.
It's almost criminal, Grant.
Look, that time I suspect will come in the future when this situation resolves itself. I suspect that history will not be kind to a series of people who've graced the cover of Time magazine as the Committee to Save the World and heroes, as Ben Bernanke was on the cover of the Atlantic, I think. And history, I suspect, will not be kind to these people, as tends to be the case once these things play out. And look, there are plenty of people who've been warning about this for some time. And
most people are poo-pooing them and saying, don't be ridiculous.
Yeah, of course. Look, that's always the lot of the person that wants to point out that the emperor has no clothes, right? You're there to be laughed at, and it's fine. And look, believe me, no one, with the possible exception of Peter Schiff, is going to be end dancing if they're proven right, because it will for them as well as everybody else, create a set of problems which will be incredibly difficult to manage. But people assume that when you talk about the reality of this situation, that what you're saying is the sky's falling in. That's because you're not kind of touting the CNBC line, everything's great, everything goes up, buy the dip. It really is about awareness, Kerry. It really is about, as you've pointed towards in this conversation, just understand the reality, because it is possible to hold those two opposing thoughts in your head at the same time. It is possible to understand that the world is in serious trouble, but the markets are going to keep going up for the near future. That's absolutely fine. The danger is thinking the markets are going up because the world is in a great place. That's where you end up holding on to your stock portfolios too long. That's where you end up taking out more leverage because you think this will go on forever. As long as you understand that these things are happening in spite of the underlying economic conditions, you're ahead of the game. And you will, if you have a plan, likely have a chance to get out before the damage gets too bad. The big thing I think people need to worry about now, and you touched on it a moment ago there, is this idea that inflation is returning. Because as I've talked about a lot recently, and the podcast, The Endgame, that Bill Fleckenstein and I've done together, this idea about the possible return of inflation has just organically pushed itself to the front of the conversation, because there are so many brilliantly smart people, half of whom say deflation is going to continue. You don't have to worry about inflation, and whatever's happening now is transitory. And there are other equally smart people who, in many cases, have been deflationists for the last multiple decades, who've now jumped ship and said, okay, this is the time. We're seeing the churn and inflation is coming and it's going to be a problem. Now, listening to those people laying out their theories on this, again, it comes down to the individual. You can listen to both sides argue. You have to understand, nobody knows, right? This is all a guess about the future, based on experience, based on understanding of the market conditions, based on history, whatever it may be. It's an educated guess, but it is a guess. It's up to everybody, and it's incumbent upon every investor to understand the debate on both sides, and then decide what you think is right. If you think that inflation isn't a problem, you are likely fine. Your portfolio is set up in the right way to deal with it, because it means a continuation of the conditions we've had over the last number of years. It means your bonds will probably go up. It means your equities will probably go up. You don't need to own any commodities. That's fine. But if you think, based on the preponderance of evidence presented to you by a series of very, very smart, experienced people, if you think the people who are saying, okay, what you need to be worried about for the next 10 years is inflation, well, then you have some serious portfolio rebalancing to do, because what's worked for the last 50 years, essentially, with the exception of the 70s, when we did have that kind of inflationary spike, incidentally, which began immediately the world was taken off the gold standard. If you think that inflation is coming back, well, then your portfolio is likely set up in literally the worst way possible to deal with inflationary environment. You're long bonds, you're long duration. Yes, you're probably long equities, and they will, in nominal terms, likely go higher, but you don't have any commodities. You're exposed to growth and not value in that equity portfolio, and those growth stocks will start to get re-rated much lower. So you have an awful lot of big decisions to make, and they are big decisions, and you've got a choice. You can either find someone you trust who you think has the same view as you for the 10 years going forward and ask them to make those decisions for you, or you have to really get involved, roll your sleeves up, understand what inflation means for different asset classes, understand what inflation would do to your portfolio, and make the necessary adjustments. But abdicating and leaving that thinking to other people and not really taking the time to understand what a return of inflation would mean is a very, very, I think, lazy and foolish thing to do. And it's incumbent upon everybody with any capital, any wealth, any savings that they've deployed in any way, shape, or form to understand this and think it through.
Well, if you wouldn't mind, let's unpack. We've got a little bit of time here, Grant. Let's unpack it. We're not there yet, but let's just say we're heading towards that inflationary economy, and it potentially will hit faster than people think. In order to, we always talk about growing and protecting your wealth. What would you do in an inflationary environment? And then I want to talk a little bit specifically about gold. This is a virtual gold conference, and I know some of your views on gold, but what would you do? What do you think people need to do to protect that portfolio in that inflationary environment?
Well, I think you said it perfectly in the question, Kerry. You said we always talk about growing and protecting our wealth, which we do, but we've come to talk about them concurrently, right? The reality of it is what we have to do is grow and protect our wealth. Now, we've grown it over the last 10, 15 years. Right? So since the lows in 2009, all we've done is grow our wealth.
Yeah.
But people think about growing and protecting it. What about we need to grow, then protect our wealth? And recognizing that we've been through the growth phase and there is a high material possibility that we are now moving into the then protect our wealth stage. And if that's the case, to my previous point, you need to think things through and probably rebalance an awful lot of things. If you are now going from growth mode to protection mode, then by definition, you have to own the things you haven't owned. You have to sell the things that have given you that growth, because they will be the things most heavily punished. And again, and the other thing that's, I think, most important at this point is, what's your time frame? If you're a 24-year-old and you've been in the markets for a couple of years since you've been at work and you've been investing and you've been starting your 401k, look, you might have a nasty shock to come at some point in the next year or two, but you've got best part of 40 years to make it up. And so it's not so important to you. If you're near retirement age and you have been, right, like both of us, you've been gifted these remarkable gains in your portfolio at this late stage, you've got no income. You don't have any coupon interest coming into your portfolio, which you should now, if you're near retirement, you should have a very heavy bond component of your portfolio, and that should be paying you an income stream that you can live off. Well, of course, you can't live off a handful of basis points, but you've been compensated by the capital gains you've made in your bond portfolio and the capital gains you've made in your equity portfolio, which is great, right? I mean, that's fantastic. But if your time frame is immediate, then you have to be a lot more serious about the changes you're going to make. If you're entering retirement and you're thinking, well, I'm going to live for another 20, 30 years, you don't have time to be wrong. You don't have time to make it up if you suffer a big drawdown. That's the death knell. So there are two different things here: people with short time preferences, people with long time preferences. If you are trying to invest, and I work with some families, and I've had some meetings with a family I did some work with recently, looking to basically secure what's happened to their family in the last 10, 15 years and make sure that their family is set for generations to come. And to do that, they are not only having to think about the fact that inflation is likely to be over the next 10, maybe 20 years, that's going to be the problem they have to face. It allows them to construct a portfolio today that it's okay if it's wrong for the next couple of years. If they construct a portfolio to protect them from inflation over the next 20 years and the status quo continues, it's not going to hurt them necessarily. And if it does hurt them, what they're going to be losing is they won't be keeping up with the gains that a different portfolio would have had, but their money is ideally not going to get eaten away. But when inflation hits, they will perform very, very well. So understanding that time frame, understanding a time preference and the kind of how far out you're trying to protect yourself for dictates really everything on how you set your portfolio up. And so this idea that what do I do about inflation is spurious, because if you're a 20-something trying to guard against inflation, it's a very different answer to if you're a 65, 70-year-old. Vastly different and life-changingly different answers. So people have to be very, very cognizant of that.
We don't have a lot of time left. So one of the things I wanted to do, Grant, is I know you have purchased physical gold in the past, and I think that you bought it when it was about, I think I think it was $333 at the time.
You have a very good memory. Yes, that's exactly right. How funny.
And that you also say that you don't look at the price. You look at
That's
how it's the purchasing power. Can you just expand on that? Because this is a virtual gold conference. We're going to be talking to Janie Simpson next from ABC Bullion about, the ABC of investing in gold, like just to unpack it and keep it. Because a lot of people are like, a confused mind never buys. It's like, oh, it's all too confusing. I can't do it. Could you just share with our audience, what was the reasoning behind you buying that first ounce of gold? And I know that it was, the weight of it. And it's like, you hand over the paper and you get back a physical gold, and it's a totally different experience. So if you could just share that with our listeners, and also what your views are at the moment about gold equities and gold bullion.
Sure. Look, gold to me, the decision to buy gold really was just something I came to from reading history. I was in the markets for many years until I bought my first gold, almost 20 years before I bought. I was aware of the price, but I didn't follow the gold price. I'd never owned it. I didn't really care about it. I used it as a barometer for certain areas of the market, but I never felt the need to own it. And then when it came to 2000, and I saw what the central bank reactions were to the dot-com bubble collapsing, hot on the heels of how they bailed out LTCM in 98, it became clear to me what the future was going to be, and that was going to ultimately be currency debasement. And so I wanted to own gold as a hedge against that. Now, buying gold as I did in the early 2000s has meant that for me, my gold has outperformed the stock market since then. And so this does come down to timing. So just by sitting on that gold and really not worrying about it and not worrying about the price, but knowing that it was something I wanted to own as a liquidity reserve, own as a capital asset, allowed me to just ignore the price fluctuations for many reasons. Now, a lot of people do focus on the price, and they want to buy gold at $1,700 because they think it's going to 5,000, which is absolutely fine. But if that's your mindset, then you do tend to live and breathe every up and down. And as you and I know so well, there are so many inexplicable periods where gold goes down when you think it should go up, and it goes up for no reason. If the price is what you're focused on, it becomes much harder to put the emotion aside in gold. And look, gold has no metrics upon which you can value it. Right? It doesn't have anything you can value on other than emotion. And so, of course, it's going to be an emotional asset, and it's going to be a volatile asset. So, I've owned it for that period of time. I've added to that over time. I've never sold any physical gold ever. But then you asked, your second part of your question was about the miners, which I'll come to in 1 second. My thoughts on gold are not to sell it, but at some point to exchange it for something that I want to own more.
Yeah.
And so that brings you to the idea of purchasing power. There's this old saw that an ounce of gold has maintained the ability to pay for a tailored man's suit since Roman times. You could buy a tailored toga for an ounce of gold back in Roman times, and today $1,700 will get you a nice tailor-made suit. And that purchasing power protection is really what gold's all about. And so what I think about is, if you have a safety deposit box full of gold, that today, you could buy a one-bedroom apartment with somewhere. There may come a point in the middle of a property market crash that same deposit box full of gold will buy you, let's say, a 3-bedroom apartment somewhere. It maintains its purchasing power. And if you go back to 2008, a lot of people remember the initial move by gold was down in 2008. And everybody was saying, well, see, even gold doesn't protect you. It doesn't protect you. Gold's going down as well. Why is gold not going up? But if you'd looked at going into the crisis, how many, for example, units of the S&P 500 an ounce of gold would have bought you, and you looked at it when the S&P fell 66% and gold fell 10%, then you realize that I could have swapped my gold for 3 times the S&P that I would have been able to swap it for prior to the crisis. So it's that mindset. It's not about the gold price. It's what can I do with that gold? What can I exchange it for?
Right.
So to come back to the miners, look, I think the mining stocks are fantastic levered plays on gold. If you believe gold to be going higher in price over time, or to become more important, as I do, then the miners offer you a tremendous way to gain leverage to that. But what they also bring is massive amounts of volatility, and they are like untamed horses. They will perform really, really well, and then for no reason they'll just crater. And people that don't understand this and are levered will be thrown out of this trade so many times. Again, if you go back to history and you look at what gold miners did during the Great Depression, for example, the best performing stock was home stake mining.
Oh, wow.
If you look back at the 70s, you'll see the mining stocks did really, really well, and they will do again. When gold has its moment, the mining stocks will offer you tremendous gearing to that and incredible leverage to the upside. But you will have to withstand some incredible emotional shock. So the answer with gold miners is to understand the business, understand the assets, really understand the management, and then not be too leveraged and not put your entire position on in one go. You need to be able to buy dips in gold miners. If you're fully invested in them, then all you have is the volatility, and it takes an incredibly strong stomach if you're fully invested in gold miners to withstand the drawdowns that you take. If you're leveraged, it becomes impossible to take some of those drawdowns. You'll get margined out. So there is a real discipline to investing in gold mining stocks. It begins with understanding management and the asset, the jurisdiction, and the potential challenges they face. But it ends in sizing the position correctly, understanding the emotional roller coaster ride you're likely to be on with this thing, and being able to withstand it. It's those are kind of the three pillars that you have to be able to do to invest in gold mining stocks. Otherwise, maybe you get lucky, maybe you get unlucky, but you're rolling the dice and it's a craps table.
Grant, one of the things I want to do, and I want you to share with all of our listeners here, because I do love your podcasts, and you also talk to some fascinating people. So I mentioned right at the start of our chat, it was Grant-Williams, not dot, ladies and gentlemen, -Williams.com. Just talk to us a little bit about what you do and how people can find you and some of the things that you cover. And, are you talking to people about gold? Are you talking to people about finance? Just give us an overview.
Sure, thank you. I've been writing things that make you go for over a decade now. And it's really it's a monthly publication, and I talk about anything that I find interesting in that month that I think is important, and most of it is signs that some of these things we're talking about are coming to pass. I talk about gold fairly regularly in that because it's a core position for me. It's something that I spent an awful lot of time trying to understand over the last 25 years. And then I have, 4 different podcast streams. One of them I co-host with Stephanie Pomboy, which is the super terrific Happy Hour you mentioned earlier. Another series is called The End Game with Bill Fleckenstein, The Narrative Game with Dr. Ben Hunt. And then the Grant Williams podcast is a series of conversations, just me and people, as you say, that are interesting. And, the response has been overwhelming to them. They're all really just attempts to find smart people and listen to them. Ask them some questions and then get out of their way and let them educate and inform people about the way they see the world, what they think might happen. And again, we've had great minds contrasting and arguing with each other every week. And that's really the beauty of it, right? I mean, getting smart people to argue both sides for you and then making up your own mind is really what it should all be about. So that's what I try and do. And I say I've been overwhelmed with the response, and I've enjoyed every single one of those conversations so far.
Well, as I say to people all the time, you've got to be resourceful. You've got to get educated. And if you really want to get educated, people like Grant Williams and the people that he talks to, I'm telling you now, it's the old saying, do yourself a favor, go and have a look at it right now. Go and subscribe, grant-williams.com. Grant Williams, all the way from the UK, thank you for being our opening keynote at the Virtual Gold Conference today. It's been an absolute pleasure just hearing your views on what's going on. And remember, ladies and gentlemen, we've got to protect, not just grow our wealth. Thanks, Grant.
Kerry, thanks for having me. I'd long for the day and get back down to Oz soon, so hopefully we can get out for a dinner at that point if we're allowed.
Absolutely. See you soon.
Cheers.
ABC Bullion, the Australian bullion company. Trading since 1972, ABC Bullion is Australia's largest independent bullion dealer and precious metals depository. Fully insured and verified by independent audit. ABC Bullion offers a range of proprietary investment products and storage solutions and Australia's first gold and silver accumulation plan. ABC Bullion.